Assalamualaikum warahmatullahi wabarakatuh. My name is Dini Syaikal bin Zaharuddin and I am from class DBS 6A. My ID number is MDB20070116. And my group member is Aiman Zikri, Adam Saleh, Ziad Syakirin and Muhammad Alif Haikal. And today we are going to present about our assignment, Business Finance, and our lecturer is Madam Syaira binti Matsari. So I'm going to pass to Ziad Syakirin to present his part.
Now I want to present about liquidity ratio. Liquidity ratios are a type of financial indicator that assess a debtor's capacity to repay current debt commitments without raising external capital. Liquidity ratios use parameters to determine a company's capacity to meet debt obligations and margin of safety. Now let's take a look at current ratio. The purpose of current ratio is to measure a company's ability to pay short-term obligations or those due within 1 year. Formula of current ratio are current assets divided by current liabilities. So current ratio for this company, which is Hikmah Bakti, is 2 times, which is lower than industry average, which is 2.1 times. Next, quick ratio. Quick ratio, the purpose is indicates whether a firm has enough current asset to cover its current liabilities without selling inventories. Formula of quick ratio is current asset minus inventory minus prepaid expenses and divided by current liabilities. So Hikmah Bakti Berhad, quick ratio for Hikmah Bakti Berhad is 1.18 times, which is higher than industry average. Next, efficiency ratios or assets management ratios. The purpose of efficiency ratios is to measure how effectively the firm is managing its assets and generating sales. These ratios will indicate whether the assets are too high, too low, or reasonable for the firm's current and project operating levels. They show the amount of sales generated for every dollar of asset investment. So because we live in Malaysia, so for every ringgit of asset investment. Okay, first, inventory turnover ratio. Inventory turnover ratio, the purpose is this ratio indicates how many times the inventory is sold and replaced in a year. The formula of this ratio is cost of goods sold divided by closed inventory, and Hikmah Bakti Berhad for inventory turnover ratio for Hikmah Bakti Berhad is 7.48 times, which is higher than industry average. Next, average collection periods. The purpose of average collection periods is this ratio indicates the number of days taken by a firm to collect its accounts receivable and reflects the company's credit policy. Formula of average collection periods are account receivable divided by annual credit sales and multiplied by 365 days. Honestly, it is 365 days. It is some mistake in this slide. So average collection periods for Hikmah Bakti is 40 days, which are higher than industry average. Then, non-current assets turnover ratio. The purpose of this ratio is to measure the firm's efficiency in utilizing its property, plant, and equipment and generating sales. Formula of this ratio is sales divided by net non-current asset. So Hikmah Bakti get 2.5 times, which are higher than industry average. Next, total assets turnover ratio. The purpose of total asset turnover ratio is the total asset turnover ratio compares the sales of a company to its asset base. The ratio measures the ability of an organization to efficiently produce sales and is typically used by third parties to evaluate the operation of business. Formula of total assets turnover ratio is sales divided by total assets. So Hikmat Bakti total asset turnover ratio is 1.52 times, which is lower than industry average. Okay, now we take a look at leverage ratios. The purpose of leverage ratios is to measure the level of debts or borrowings in a firm. This ratio also used to increase the potential return of an investment. Not only that, by doing leverage ratio, the company can identify whether the company use more debt financing to finance its assets and operation as compared to equity financing. Debt ratio. The purpose of debt ratio is to demonstrate a company's ability to repay its debt with its assets. This ratio also can help the investor to determine the company's debt burden and company's ability to repay the debt in the future. Formula for debt ratio is total debts divided by total assets. And to get the total debt is current liabilities plus by non-current liabilities, and to get the total asset, current assets plus non-current assets. So Hikmat Bakti debt ratio is 30.36%, which is lower than industry average. Next, debt equity ratio. The purpose of debt equity ratio is to measure the percentage of borrowings that used by the company compared with total equity. Formula of debt equity ratio is total debts divided by total equity. To get the total debts, we must take the current liabilities plus non-current liabilities. And where to get the total equity, we get the ordinary share plus with retained earnings. So Hikmat Bakti Berhad gets 5.62%, which is lower than industry average. Lastly, time interest earned. The purpose of time interest earned is able to measure the firm's ability to cover its interest charge out of its operating profits, or in other words, the ability of a company to pay its debt. Formula of time interest earned is earnings before interest and tax divided by interest expenses. So Hikmat Bakti Berhad time interest earned is 6.67 times, which is lower than industry average, which is 7 times. That's all from me now.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Ali Faikal bin Asnuddin. Now I am going to talk about profitability. The purpose of the profitability ratios is to measure how effectively the firm uses its assets to make profits. They show the profits earned for every ringgit of sales made, or the profits earned per ringgit of investment in assets. It also indicates the firm's efficiency in controlling costs and its pricing policy. The first one is gross profit margin. Gross profit margin shows the percentage of sales remaining after deducting the cost of making such sales. So the formula of gross profit margin is gross profit divided by sales, and the amount for Hikmat Bakti Berhad is 7,002,000 and divided with 17 million equals to 42.35%. So if we compare with the industry average 88%, Hikmat Bakti had a better gross profit margin than the industry average, which is good. And for improvement, Hikmat Bakti need to reduce unnecessary costs such as labor costs. And next is operating profit margin. Operating margin represent how efficiently a company is able to generate profit through its core operation. It is derived after deducting all costs and expenses, excluding interest charge and tax from the sales figure. Operating profit margin formula is earning before interest and tax divided by sales. So for Hikmat Bakti amount, it is 2 million and 400,000 divided with 17 million. So it is equal to 14.12%. So for comparison with industry average, Hikmah Bakti operating profit margin is lower than the industry average, which is 15%. So the comparison is bad, and for improvement, Hikmah Bakti need to reduce cost of goods. For example, Hikmah Bakti work with their supplier. So for net profit margin, it indicate the pricing strategy adopted by a firm. Net profit margin formula is net income available to common stakeholders divided by sales. For Hikmah Bakti amount, it is RM1,530,000 subtract with RM140,000 divided by RM17 million. It is equal to 8.18%. So to make a comparison with industry average, which is 8%, it is good because it is higher than the industry average. So for improvement, Hikmah Bakti need to increase their revenue, such as through selling more goods or services by increasing the price. And next is return on asset. It indicates the management ability to make profit from the firm's investment in assets. Return on asset formula is net income available to common stockholders divided with total assets. So for amount for Hikmah Bakti Berhad, it is 1,530,000 subtract with RM140,000 divided with RM17 million. It is equal to 12.41%. So to compare with industry average, which is 12, it is good because it is higher than the industry average. So for improvement, Hikmah Bakti need to increase the net income. For example, the entity could increase total sales for the period, and then net income will increase accordingly. And last one is return on equity. It measures the profit earned by the common stockholders for their investment in the company. Return on equity formula is net income available to common stockholder divided with common equity. For the amount is RM1,390,000 divided with RM4 million plus RM1,800,000 equals to 23.97%. So to compare with industry average, which is 20, it is good because it is higher than the industry average. So for improvement, Hikmah Bakti need to increase the profit margin as profit are in the numerator of the return on equity ratio. So next, I will pass to Adam Saleh for his part.
Assalamualaikum warahmatullahi wabarakatuh. My name is Adam Saleh bin Fariman, and I will present about marketability ratios. The purpose of marketability ratios is to give the management an indication of what investors think of the company, past performance and future prospect. Marketability ratios measure the investor's perception and judgment towards the firm's growth potential. First, earnings per share. The purpose, it indicates the profit earned per unit of issued share. Earning per share formula is net income available to common stockholder per number of ordinary share issued. The value is 1,530,000 minus by 140,000 divided 4 millions, and the answer is 0.35 ringgit per share, and the industry average for earning per share is 0.28 ringgit. Next, dividend per share. The purpose, it indicates the amount of dividend received by ordinary shareholder for each unit of ordinary share held. Our formula for dividend per share is ordinary dividends divided by number of ordinary share issued. Value is 6,000 divided by 4 million share, and the answer is 0.5 ringgit per share. And industry average for dividend per share is 0.14 ringgit. Next, dividend payout ratio. The purpose, to indicate the proportion of earnings that is distributed as dividends to shareholders. Formula is a dividend per share divided by earnings per share, and the value is for dividend per share is 0.15 divided by 0.35, and the answer is 0.4286 multiple to 100, and the answer is 42.86%, and the percent of industry average is 30%. Next, price earning ratio. The purpose for price earning ratio is to compare the current market price with earning to establish whether a stock is overvalued or undervalued. The formula is market per share divided by earning per share. This value is 3.40 divided by 0.35, and the answer is 9.71 times, and the industry average is 8.5 times. Next, dividend yield. The purpose, it compares the dividend per share received by the shareholder with the current market share price. It indicates the return earned on share. The formula is dividend per share divided by market value per share and multiply to 100. The value is 0.15 divided by 3.40 and multiply to 100, and the answer is 4.41%. And last one is our industry average for dividend yield is 5%. That's all from me. Thank you.
Okay, question B. As an officer of Al-Rajhi Bank, would you accept loan application from Hikmat Bakti? Briefly explain any three reasons for your decision. So my answer is, as an Al-Rajhi Bank officer, I would accept loan application from Hikmat Bakti. This is because based on the liquidity ratio, the company has ability to meet in short-term financial obligation. The current ratio of Hikmat Bakti indicates that a firm has enough current asset to cover its current liabilities without selling inventory, since its ratio is more than industry average. Based on the leverage ratio, the firm's ability to repay its debt with its asset and the percentage of borrowings that used by the firm compared with total equity are good than average industry. Based on the profitability ratio, most of the ratio are better than industry average, such as gross profit margin, net profit margin, return on asset, and return on equity. This is indicate that the firm efficiently use its asset to make profit.
Average performance as shown in the industry average may not be desirable. Publish industry average only guidelines. Logically, all companies would like to be better than average. It could be better for a firm to make comparisons with market leaders. Inflation distort the firm's financial statements. It will cause the recorded value to be different from the true value. Hence, it can be misleading, and therefore judgment must be used before a conclusion is made. Comparison with industry. average is difficult for conglomerates. If a firm is involved in various kinds of businesses or has many divisions in a different industry, its industry category is often difficult to identify. Ratio analysis is more useful to smaller companies. It is sometimes difficult to conclude whether a ratio is good or bad. For example, a high liquidity ratio may indicate that a company is financially sound and therefore is efficient in the firm's working capital management. On the other hand, too high current ratio may also signify that the company is not managing its working capital effectively. High liquidity ratio may indicate overstocking and difficulty in collecting accounts receivable on time, as well as a surplus of idle cash. It is also difficult to conclude whether a firm's overall performance is good or bad. This is because most ratios by themselves are not highly meaningful. For example, some ratios may be good while others are bad. Hence, several of them should be combined to paint a picture of the firm's situation.